The U.S. House of Representatives has advanced a significant tax cut and border security package, reflecting former President Donald Trump's priorities. Through a key committee with a narrow 17-16 vote, this legislative effort, led by House Speaker Mike Johnson, follows a recent setback when deficit-focused Republicans initially blocked the measure. The package features front-loaded tax cuts and spending increases, with cost offsets planned for later, a strategy that has sparked concerns over its potential impact on the federal deficit. Key figures in this development include former President Trump, who continues to influence Republican legislative priorities, House Speaker Mike Johnson, and Treasury Secretary Scott Bessent. Bessent has highlighted potential consumer impacts from Trump's tariffs, particularly noting that Walmart, the largest U.S. retailer, may pass increased costs onto consumers, potentially leading to higher prices. The advancement of this package is a pivotal moment in U.S. fiscal policy, with possible short-term economic stimulation from tax cuts and increased border security funding. However, the delayed cost offsets raise concerns about long-term fiscal sustainability and the national deficit. The proposed measures could influence market sentiment, consumer spending, and business investment, with the financial community closely monitoring the legislative process. Additionally, the potential for inflationary pressures due to tariff-related price increases could affect consumer spending patterns and broader economic conditions.
Stock futures have dipped following Moody's downgrade of the U.S. credit rating from AAA to A1, aligning with other major rating agencies. This move reflects concerns over the federal government's expanding budget deficit and the challenges associated with refinancing existing U.S. debts amidst high borrowing costs. As a result, Dow Jones Industrial Average futures fell by 337 points, 0.79%. S&P 500 futures decreased by 0.97%, and NASDAQ 100 futures dropped by 1.19%. The downgrade is expected to exert pressure on bond prices and potentially elevate yields, complicating the economic landscape already strained by President Donald Trump's tariff policies. The downgrade comes on the heels of a positive week for U.S. markets, spurred by a temporary U.S.-China tariff reduction agreement, which led to a surge in the NASDAQ composite by over 7% and a 5% increase in the S&P 500. The Dow also rose by more than 3%, entering positive territory for the year. However, the credit rating downgrade has shifted market sentiment, raising concerns about the long-term fiscal health of the U.S. economy. Investors are also closely monitoring speeches from Federal Reserve officials and upcoming leading indicators data, which could further influence market dynamics.
Dollar General, NYSE, DG, has experienced a notable 15% rise in its stock price amidst a flat S&P 500 index performance in early 2025, drawing investor attention. The company's business model, which focuses on low price points and targets less affluent markets underserved by larger retailers like Walmart and Target, has historically thrived during economic downturns. This resilience is particularly appealing given current concerns about a potential U.S. recession due to geopolitical and tariff issues. However, the underlying growth story reveals a nuanced challenge. While consumer staples, accounting for 82.2% of Dollar General's 2024 sales, continue to grow, the shift towards these lower-margin products has pressured the company's overall profit margins. Dollar General's strategic response includes cost-cutting, product mix adjustments, and store upgrades aimed at enhancing long-term performance. While these efforts are part of a broader turnaround strategy, the company's reliance on lower-margin consumer staples presents a potential headwind. Investors viewing Dollar General as a recession-proof investment may overlook these underlying challenges, which could affect the company's profitability. For those considering a long-term investment, understanding the balance between Dollar General's short-term safe haven appeal and its longer-term growth hurdles is crucial.
The recent revocation of security clearance for Istanbul-based Celebi Aviation Holding by the Indian government underscores the growing importance of corporate nationality in an increasingly complex geopolitical landscape. As global tensions rise, particularly between India, China, and Turkey, companies are finding that their national affiliations are more crucial than ever. This trend challenges the notion that multinationals can operate as stateless entities, emphasizing instead the strategic importance of corporate citizenship. The move by India reflects broader concerns over national security and strategic interests, which are influencing how countries manage foreign investments and corporate operations within their borders. In this context, the concept of corporate nationality becomes a critical factor in international business strategy. Companies must navigate complex ownership structures and the geopolitical implications of their national affiliations. The ability to clearly establish corporate nationality is not only a matter of regulatory compliance, but also a strategic asset that can enhance market access and brand differentiation. As governments continue to prioritize national security and economic interests, corporate nationality helps direct investment flows and aligns multinational operations with domestic policies. This dynamic interplay between global business and national interests is shaping the future of international trade and investment, reinforcing the need for companies to strategically manage their national identities in a deglobalizing world.
Canada has temporarily paused some of its counter-tariffs against the United States, a strategic move initiated by Prime Minister Mark Carney's government in response to U.S.-imposed tariffs on Canadian goods. The Canadian Finance Minister François-Philippe Champagne clarified that despite the pause, 70% of Canada's retaliatory tariffs remain in place. This decision comes amidst ongoing economic tensions between the two countries, with the U.S. having levied general tariffs of 25% on Canadian imports, affecting sectors such as autos, steel, and aluminum. The pause in tariffs, particularly those affecting the automotive and food processing sectors, aims to provide Canadian companies with a 6-month reprieve to adjust their supply chains and reduce dependency on U.S. suppliers. Oxford Economics reported that these exemptions have effectively reduced the tariff rate on U.S. imports to nearly zero, a claim that has sparked political debate within Canada. Opposition leader Pierre Poilievre has criticized the government for allegedly easing tariffs without transparency. Despite these criticisms, the Canadian government maintains that the tariff strategy is calibrated to limit domestic economic harm while responding to U.S. trade policies. As Canada sends 3/4 of its exports to the U.S., the economic implications of these tariffs are significant, potentially affecting market sentiment and economic growth.
IonQ, a leading player in the nascent quantum computing sector, has seen its stock soar over 300% in the past year, reflecting growing investor enthusiasm for the potential of quantum technology. Quantum computing promises to revolutionize industries by performing complex calculations at unprecedented speeds, potentially creating an estimated $850 billion in economic value by 2040. However, the path to commercialization is fraught with challenges, as evidenced by IonQ's current financials. The company reported $7.6 million in revenue last quarter against a significant loss of $75.7 million, highlighting the financial strain of advancing such cutting-edge technology. Despite its promising technological prospects, IonQ's financial health raises concerns. The company holds $700 million in cash, providing some runway for continued research and development. But this has come at the cost of shareholder dilution, with a 29% increase in shares outstanding over the past 2 years. Given its current burn rate and the expectation that commercial quantum computing solutions are still years away, IonQ faces a tight timeline to achieve profitability. This uncertainty, coupled with the historical volatility of stocks in emerging tech sectors, suggests that while IonQ's technological advancements are noteworthy, its stock may not be a prudent investment at this stage for risk-averse investors.
Treasury Secretary Scott Bessent has confirmed that Walmart, the largest U.S. retailer, may pass some of the costs from President Donald Trump's tariffs onto consumers through higher prices, despite the president's warnings against such increases. This development comes amid ongoing trade negotiations with China and other major trading partners, where tariffs are a central issue. Walmart's CFO John David Rainey indicated that price increases began appearing in late April, highlighting the difficulty of maintaining low prices amidst rising costs. The tariffs are part of the Trump administration's broader trade strategy, which aims to renegotiate terms with trading partners. However, this approach has introduced significant uncertainty for businesses and consumers, complicating future planning. Bessent defended the administration's tactics as strategic, although concerns about inflation and economic stability persist, especially following a recent downgrade of U.S. government debt by Moody's Ratings. Bessent downplayed the significance of this downgrade, suggesting that it is a lagging indicator and that financial markets have already accounted for the impact. The administration's economic policies, including a tax plan projected to increase federal deficits by $3.3 trillion over the next decade, further complicate the economic outlook, while Bessent remains optimistic that economic growth will outpace debt accumulation. Many independent analysts are skeptical. As negotiations continue, the potential impact of tariffs and fiscal policies on consumer prices and market stability remains a critical focus for investors and policymakers.
During his visit to the Middle East, President Donald Trump announced significant trade agreements with Gulf states, underscoring a strategic realignment in U.S. foreign policy. The visit, which included stops in Qatar and Saudi Arabia, resulted in substantial economic deals, including Qatar Airways' record-breaking $96 billion order for Boeing aircraft, marking Boeing's largest ever wide-body and 787 order. This move aligns with Qatar Airways' expansion strategy to increase passenger capacity significantly by the decade's end. Additionally, Saudi Arabia secured a $142 billion arms deal with the U.S. and committed to a $600 billion commercial investment package in the U.S., highlighting the deepening economic ties between the U.S. and Gulf nations. The trip also emphasized advancements in technology partnerships, notably in artificial intelligence. Saudi Arabia and the UAE signed agreements with U.S. tech giants NVIDIA and AMD to acquire cutting-edge AI chips and software, facilitating the development of hyperscale data centers. These initiatives aim to drive innovation and digital transformation in the region, with Humane, a Saudi company, spearheading these efforts. The Trump administration's decision to lift export restrictions on high-end chips, previously imposed during the Biden era, reflects a strategic shift to counterbalance China's growing technological influence. This visit underscores the Gulf states' strategic importance to the U.S., not only for economic opportunities, but also for maintaining security alliances in a region marked by geopolitical complexities.
BlackRock, the American asset management giant, is reportedly in advanced negotiations to invest 500 crore rupees in the promoter group of B9 Beverages, the company behind Burra 91 craft beers. This investment is expected to be made through structured debt and will help B9 Beverages acquire stakes from early shareholders like Peak 15 Partners and Safina, while also providing fresh capital. The move comes as B9 Beverages grapples with liquidity issues, inventory losses, and a net loss of 748 crore rupees in FY24, alongside a revenue drop from 927 crore rupees in FY23 to 638 crore rupees in FY24. The company has also experienced a decline in volume sales, falling from 9 million cases in the previous fiscal year to 6 to 7 million cases in FY24. In addition to BlackRock's potential investment, B9 Beverages is planning a 100 rupees crore rights issue and aims to raise a total of $100 million from various investors and family offices. This capital infusion is intended to restructure the company's obligations and improve operational efficiency. BlackRock's investment is expected to be structured with a back-ended coupon, incentivizing B9 Beverages to achieve specific operational targets, including revenue and EBITDA goals. The strategic interest from BlackRock, which holds stakes in prominent global beverage companies like Molson Coors and Treasury Wine Estates, underscores the long-term brand potential of Burra 91, despite the current financial challenges faced by B9 Beverages.
This week, Wall Street's focus will be on a series of earnings reports from major companies such as Home Depot, Palo Alto Networks, Medtronic, Snowflake, Intuit, and Workday. These reports will provide insights into the performance and strategic direction of these companies, potentially influencing their stock prices and broader market sentiment. Additionally, economic data releases, including new and existing home sales figures and the S&P Flash U.S. Services and Manufacturing PMIs for May, are poised to offer a snapshot of the current economic landscape and consumer demand trends. In parallel, geopolitical developments, particularly the U.S.-Iran nuclear talks, are drawing attention. U.S. Special Envoy Steve Witkoff emphasized that any agreement must prohibit uranium enrichment, a stance met with resistance from Iran. This ongoing dialogue could impact global oil markets, as evidenced by the recent uptick in oil prices following U.S. President Trump's comments on potential progress in the talks. Moreover, U.S. Federal Reserve Chair Jerome Powell's upcoming commencement address is anticipated to provide further guidance on monetary policy, potentially affecting investor expectations and market dynamics. Overall, these events and their outcomes will play a crucial role in shaping market movements and investor strategies in the coming week.